So as the Fed kicks off its two-day meeting, the president has a message. Start cutting.
I would like to see a large cut, and I'd like to see immediately the quantitative tightening stop. It should be stopped. For them to have done quantitative tightening and also higher interest rates simultaneously, I think was a big mistake.
While the Fed is expected to cut rates a quarter basis points, President Trump's unrelenting pressure on the central bank comes as the American consumer continues to hold up the economy. Consumer confidence surging to 135.7. Keep in mind, that's versus an estimate of 125. Here to break it all down, Bell Point's chief strategist David Nelson and former Bain Capital managing director and author of The Upside of Inequality, Ed Conard. All right, let me start with you, David. First of all, the Fed tomorrow, what do you see happening?
Well, it's going to be 25. This is the worst-kept secret in a long time. You know, if you asked me that question a couple of weeks ago, I might have gone with the 50, but the economic data has just been too strong. You know, you're talking about a consumer confidence number that goes all the way back to Bush 1 to get higher than that. And just a couple of weeks ago, we had a monster retail sales number. So 25 is a lock, 50 is a stretch. Also, this morning, though, we did get consumer income and spending. That core PCE number, not to get too wonky here, but it is a major component for the Fed, Ed, came in at 1.6%. The Fed can't get anything around that 2% area. And this is one of the main reasons people are arguing for lower rates.
Yeah, I don't see much threat of inflation. We haven't seen inflation for decades now.
What about deflation, though?
Deflation, I think we're probably have too robust growth. It's not like we have threateningly good growth. We have welcomingly good growth at the moment. So I don't think we're going to see deflation either. I think we're going to see more of the same. So I don't see much risk at all there.
But a rate cut tomorrow is you agree with Dave in the sense that it is in the cards?
Yeah, I don't see how you can leave the rate where, I believe markets set the rates, not the Fed. The markets drop the rate a half a point, and you can't leave, the Fed funds can't stay where they are, where the market is. And you're basically restricting credit at a time when you have good growth, not threateningly good growth. So why in the world would you want to restrict credit? You have to reduce the rate.
There are pockets, though, of weakness in the economy. Even though we had a pending home sales today that came in better than expected, it was a reminder, the first year-over-year increase in 17 months. Yeah. So we've got large swaths within the economy that need help. Listen, I know the Fed seems like their breadth of what they use to determine their actions gets wider and wider every day. How important are things like manufacturing and housing?
They're all important. And I think what the Fed is going to call this is likely going to be termed an insurance cut. But I look at the yield curve, and it almost demands a cut. And we look at, economies.
So then why just 25 basis points? A week ago, New York Fed President Williams said, hey, we don't have that many arrows in a quiver. Yes, let's use them all now.
Why do that? You could spread that out. You'll probably get one now, probably another in September, and maybe one more at the end of the year. It's clearly going to happen. We're inverted all the way out beyond 10 years. Germany is negative all the way out to 17. It's going to happen.
And I consider you to be an economic genius / purist. Are you concerned about these low rates? Are you concerned? In the last 3 days, Barron's had a negative article on software stocks and used the word bubble. J.P. Morgan has brought up the term overvalued. This morning, we had a couple of firms use the word bubble with respect to a whole lot of areas in this economy. Are you concerned about the negative impact of keeping rates this low this long?
No, I'm not concerned about bubbles. The way you get growth is through speculation. I'm not a big fan of financial speculation. We can't really control it, but high stock market means companies are more likely to invest, trying to drive up their stock markets. I don't see much threat of any overinvestment or over-speculation at this point. We're getting nice, moderate, steady growth in the 2 to 2.5% range. It's exactly where we want it to be. I think the real rate cut here is probably more than a quarter and less than a half. So they're not going to go to a half. They'll go to a quarter and then suss it out and see how it goes.
And then later on go another quarter at least.
They might.
The streets right now is sort of handicapping 3 rate cuts between now and the end of the year.
Yeah, even coming into tomorrow, 16% of economists think it's going to be 50. I don't see that happening. There are some excesses out there. I mean, corporate debt is now approaching record levels.
You got cautious not long ago, right? If I recall a conversation
I'm going to be very happy to end the year kind of where we are right now and let these valuations. I kept saying that, but that was 5% ago. Okay.
I just think with interest rates where they are, you should be using more debt than equity. So you should expect a rise in corporate debt.
To be fair, there are some excesses out there. There are some tech valuations out there where on a GAAP basis, they're actually losing money. So some companies making $1.66 like Workday.
Only the purest genius use GAAP.
Okay. Call me a wonk.
All right, see you guys later. Thank you both, Ed and David.